Welcome back to the Deep Dive. Today we are stripping everything back. We are looking at a book that is, well, it's widely considered the Bible of its field.
And that's not an exaggeration, really. In this case, it's completely justified.
We are talking about The Intelligent Investor by Benjamin Graham. And I think we have to just address the elephant in the room right away.
The date on the cover.
The date, 1949. So the skeptic in me, and I know the skeptic in you listening, is asking, how can a book written before the internet, before high-frequency trading, before crypto,
Before any of it.
how could it possibly tell us how to survive in today's market?
It's a totally valid question, but I think the answer is in who endorses it. Warren Buffett calls this, and I'm quoting, by far the best book on investing ever written.
He also said Graham influenced his life more than anyone except his father.
Which is a huge statement. And the reason it holds up is because Graham focuses on the one thing that never, ever changes. Human nature. The technology changes, the markets change, but, greed, fear, the tendency we all have to make terrible decisions under pressure.
That's timeless.
Exactly. It's the same today as it was in 1949.
Okay, so our mission today is to take this massive text, it's over 600 pages, with the commentary.
With Jason Zweig's commentary, which is excellent.
And distill it.
Yeah.
Give you the practical framework Graham designed. And it has to start with the title itself, right? The Intelligent Investor.
Mm-hmm.
Because my first thought when I hear intelligent is, IQ scores, SATs, the math genius.
But Graham throws that out, immediately.
In the first chapter,
Yeah.
he says that's not it at all.
Not at all. In his world, intelligence isn't about brain power, it's about character. It's emotional control. He uses the story of Sir Isaac Newton to prove it.
The guy who invented calculus? You can't get much smarter than that.
You'd think not, but back in 1720, there was this huge bubble, the South Sea bubble.
The meme stock of its day.
Basically, yeah. And Newton owned shares. He was smart enough to see he was getting crazy, so he sold and made a huge profit, something like 7,000 pounds.
We won. Smart move.
It was a smart move. But then he watched the market keep going up. He saw his friends getting rich, people he probably thought were dumber than him. And the FOMO, the fear of missing out, it ate him alive.
Oh, no.
He jumped back in at a much, much higher price.
And then bubble burst.
Of course. And he lost everything, 20,000 pounds, his life's fortune. He famously said, I can calculate the motions of heavenly bodies, but not the madness of people.
That's terrifying. If Newton can lose his shirt because of emotion, what chance do the rest of us have?
And that is Graham's whole point. Intelligence here is patience, discipline. It's the ability to tell the crowd, no thank you, and to control your own emotions.
So character is the foundation.
Got it.
With the first actual rule, because he draws this very hard line right at the beginning.
He does. Between investment and speculation.
Two words we use, completely interchangeably now.
We do. People say I'm investing in Dogecoin or whatever. To Graham, that's just nonsense. They are polar opposites.
So what is his strict definition of an investment?
It's a three-part test. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return.
Okay, so 1, thorough analysis. 2, safety of principal. 3, an adequate return.
And if any one of those three is missing, you are not investing.
You're speculating.
You are speculating, full stop. So if you buy a stock because a guy on TikTok told you to,
No analysis.
or because the price just went up 100%.
No safety of principal.
You're just gambling. You're betting that a greater fool will buy it from you at a higher price tomorrow.
But he's not saying you can't speculate, is he?
No, not at all. He's a realist. He just says, know what you're doing. Treat it like a trip to Vegas. Take a small amount of money you can afford to lose, maybe 10% of your capital, max, and put it in a totally separate account.
Don't mix your gambling money with your investment money.
Never. The problem is, in a big bull market, everyone starts to think their gambling is genius-level investing.
Right. When the price is high, it feels safe. When it's low and cheap, it feels risky.
Which is the exact opposite of how it actually works. And that leads right into, I think, the most famous part of the book, Chapter 8.
Mr. Market.
Mr. Market. It's such a brilliant metaphor.
Explain it for someone who hasn't heard it.
Okay, so Graham says to imagine you own a piece of a business and you have a business partner. His name is Mr. Market.
And he's a little unstable.
He's a manic depressive. Every single day, he comes to your office and offers to either buy your share from you or sell you his share.
But his mood dictates the price.
Completely. Some days he's euphoric, he thinks the business will conquer the world, and he'll offer you a ridiculously high price. Other days, he's terrified, thinks you're going bankrupt, and he offers to sell you his share for pennies on the dollar.
The key is you don't have to trade with him.
That's the whole secret. You can just shut the door. A rational person would use his moods. When he's depressed and offering a silly low price, you buy from him.
And when he's ecstatic and offering a crazy high price, you sell to him.
Exactly. But what do most people do in the real world? They look at the stock ticker, which is just Mr. Market shouting his prices, and they let his mood become their mood.
They let the servant become the master.
That's it. You turn a massive advantage into a huge disadvantage. This is why Graham says the investor's chief problem and worst enemy is likely to be himself, the enemy in the mirror.
Okay, so we've got the mindset. We're ignoring Mr. Market's mood swings.
Yeah.
But what do we actually buy? Graham splits investors into two camps here.
The defensive investor and the enterprising investor.
And it's really important to define these because enterprising doesn't just mean takes more risk.
No, the only difference is work, the amount of time and effort you're willing to commit.
So let's start with the defensive investor. This is probably most of us. People with jobs, families, they want safety and freedom from bother.
Right. An autopilot strategy. Graham's suggestion was a simple 50-50 split. 50% in high-grade bonds, 50% in a diversified portfolio of stocks.
And you can tweak that a little.
Yeah, you could go to 75-25 in either direction if the market is at an extreme. But the key is you never go 100% in or out. It forces discipline.
And for the stocks, what's the rule?
For the defensive investor, it's boring. Large, prominent, conservatively financed companies. He liked to see a long, uninterrupted record of paying dividends, like 20 years plus.
And you combine that with dollar cost averaging.
Yes. Which is just the simple act of investing the same amount of money every month and no matter what.
So when prices are low, your fixed amount buys more shares.
And when prices are high, it buys fewer. You're automatically buying more when things are cheap without even thinking about it.
Now, there's a modern update to this that's critical.
From Zweig's commentary, yeah. Graham wrote this before the index fund was invented. But a low-cost index fund, like one that tracks the S&P 500, is basically the perfect tool for the modern defensive investor. It's diversified, it's cheap, and it requires zero work. It's the ultimate expression of Graham's advice for this group.
Okay, that's the defensive side. But what if you want to do the work? What if you're aiming to beat the market? That's the enterprising investor.
It is, and I really have to stress, Graham makes it clear this is a serious commitment, not something you dabble in.
So if you're willing to put in the hours, what are you looking for?
Well, he starts with what to avoid. No junk bonds. He's very against IPOs, initial public offerings.
Why IPOs? They're always so exciting.
That's the problem. They're sold when excitement is highest, and they're being sold to you by insiders who know the business way better than you do. You're buying when the smart money is selling.
He had a funny name for them, didn't he?
Imaginary profits only.
I like that. So what do you buy?
You're hunting for bargains. The classic Graham method was looking for stocks selling for less than their net working capital.
Okay, break that down. That sounds complicated.
It's actually simple. Imagine a company shuts down. It sells all its current assets, cash, inventory, and uses that money to pay off all its debt. Whatever cash is left is the net working capital.
And Graham looked for companies where the stock price was less than that pile of cash.
Exactly. You were essentially buying the cash for, say, 70 cents on the dollar and getting the factories and the brand name for free.
Do those even exist anymore?
Very rarely in the US, but the principle holds up. The modern version might be looking for unpopular large companies. You know, a solid business that hits a temporary fixable problem. The market panics.
And the enterprising investor steps in.
While everyone else is running away.
Let's touch on inflation because he dedicates a whole chapter to it.
Yeah, and it's so important. People think cash is safe, right? Put it under the mattress. But Graham points out that's a guaranteed way to lose purchasing power over time.
Because inflation is eating it away.
It's a silent tax. Stocks are a decent hedge because companies can raise their prices, but it's not perfect. Zweig's commentary adds things like REITs and TIPS inflation-protected bonds, which are great modern tools.
All right, let's get to the climax of the book, the big secret. If you had to boil it all down to 3 words.
Margin of safety.
It sounds like a term from engineering.
It is. He uses the analogy of building a bridge. If you know a 10,000-pound truck needs to cross it, you don't build the bridge to hold exactly 10,000 pounds.
No way. You build it to hold 20,000 or 30,000 pounds.
Exactly. You build in a buffer, a margin of safety. That accounts for errors, bad luck, things you can't predict.
And in investing, that means?
You never buy a stock for what you think it's worth. You always buy it for less. If your analysis tells you a company is worth $10 per share, you wait until Mr. Market has a breakdown and offers it to you for $6.
That $4 difference is your margin of safety.
That is your buffer against being wrong. And you will be wrong sometimes. The future is uncertain. The margin of safety is what makes investing a sane activity.
So paradoxically, buying a stock cheap is what makes it safe.
That's the absolute core of it. Risk is not in the asset, it's in the price you pay. A great company bought at a terrible price is a risky investment. A mediocre company bought at a huge discount can be a very safe one.
I have to play devil's advocate, though. There's the efficient market hypothesis, which says all this is pointless.
Yeah.
That you can't find bargains because prices reflect all information instantly.
And Buffett has the perfect rebuttal to that. It's in the appendix, an essay called The Super Investors of Graham and Doddsville.
Sounds like a magical place.
It's a metaphor for the investors who came from Graham's intellectual school. Buffett says, look, if 200 million people flipped coins, a few would get heads 20 times in a row just by luck.
Right.
But what if you found out that a disproportionate number of those winners all came from the same tiny town and all learned from the same teacher?
You would call it luck anymore. You'd investigate the teacher.
Precisely. And he shows that investors who followed Graham's philosophy, people like Walter Schloss, Bill Ruane, they all beat the market over decades.
But they weren't all buying the same stocks.
That's the crucial proof. They had totally different portfolios. What they shared was the philosophy. They all demanded a margin of safety. It proves the method works.
So as we wrap this up, let's just sell it one last time. What are the pillars we can use today?
I think there are 4. 1, a stock is not a lottery ticket. It is ownership in a business.
2,
2, Mr. Market is your servant, not your guide. Use his moods, don't adopt them.
3, know the difference between investment, which requires analysis, and speculation, which is a gamble.
And 4, the most important of all, always insist on a margin of safety. It's the central concept.
It's incredible how, at the end of the day, none of this is really about complex math. It's all psychology.
It's a journey of character. That's the real lesson. You don't need to be a genius. You just need to have the discipline to not be your own worst enemy.
Check the mirror before you check the ticker.
That's it. And remember Graham's mantra for all market weather, this too shall pass.
When you feel like a genius in a bull market.
This too shall pass. Don't get greedy.
And when you feel sick to your stomach in a crash.
This too shall pass. Don't panic.
A perfect place to leave it.
Yeah.
The principles in The Intelligent Investor are the bedrock for anyone serious about this.
They absolutely are.
Thanks for listening to this deep dive. Go check your portfolio, check your emotions, and we'll see you next time.